Good afternoon and welcome to Sense Financial Services webinar on how to navigate the banking crisis and come out on top. Today, I'm joined by Kreighton Reed, which I known for about 7 years. We met back in 2016, and Kreighton did an amazing job growing the bank to the level where it's at. He is currently serving as Executive Vice President of Solera National Bank. He's been in the banking sector for 15 years. Solera Bank is a billion-dollar bank, which is headquartered in Lakewood, Colorado. It was established in 2007, and Kreighton leads the deposits and self-directed side of the bank. He and his wife have 4 children, and they reside in southern Utah. Kreighton, welcome.
Thank you, Dmitry. Excited to talk today. Lots of people are curious about this topic.
Yes, yeah. So it is definitely timing. Thanks for giving us your time. I know you're very busy, and I'm sure it's going to be productive and very informative. We are recording this, so recording will be made available shortly. We'll send you a link, all. And if you guys have any questions, I have some questions to ask Kreighton. We had a number of questions submitted during the registration. We're going to try to get to most of them, if not all. And then if you guys think of any other questions as we speak, you can use the Q&A, the chat section of the webinar in your control panel, and you can put your questions there. Okay, well, Kreighton, do you want to maybe take just a quick moment and tell us just a little bit more about yourself and your history and just
Sure. Yeah.
Most people know Solera. Most of them probably don't know you, but just give us a quick summary.
Nice. Yeah. Well, I started in the banking industry at a very large bank with Wells Fargo, and I worked with them for 10 years, and I got to see the giant corporate bank. And when I left Wells, I wanted to go to the exact opposite, and so I went to a small community bank in Denver, and it's been really interesting to see both the largest, one of the largest, banks in America, and then working at a very small bank. We are, as Dmitry said, $1 billion in assets. So that basically means we have $1 billion of deposits and $1 billion of loans and bonds. And what happened with SVB and Signature Bank, I think it rattled a lot of bankers across the country, and I think we've all been answering a bunch of questions. I kind of like to jump right into that, Dmitry. I think it'd be interesting for your viewers or your listeners to hear what is the process and what happens when a bank is going to get shut down, and what's the timeline, and what's stuff that some signs that people can see, and so is that a good place to start?
Okay, thank you. So, Kreighton, you are inside of this industry, and you're kind of watching this from the outside, and some of us are concerned about what's going on. Some might be concerned a lot about what's going on with this banking crisis. But can you give us your perspective, kind of insider's perspective on what's happening internally in the bank, and since the collapse of the couple of banks here in very recent time?
Yeah. A lot of people that I've talked to, banking when people think of banks, they at times they tend to think that most banks are similar or they're alike, but they're actually very different from each other. And SVB and Signature are very different than most other banks. I will say this though: every bank has its own Achilles heel, and any time that there's a disruption in the market or in rates or in anything, that Achilles heel can be exposed. And so, we saw with SVB and with Signature Bank that their Achilles heel was unlike most banks, and that was liquidity. If you look back at all the banks that have failed recently and in the past, most of them have, if not all of them, have not failed because of liquidity. They failed because of bad loans or losses. And so, from an insider's perspective, I'd say most banks in America have great liquidity, and it made all bankers kind of go look at their liquidity and make sure that, hey, if there was a run on, on their bank, that's the first thing that we looked at. The other thing that we looked at was how many of our accounts are over the $250,000 limit. And if you've read the news about SVB, it was like 90-something% of their accounts were over that 250 limit. For us, it's less than 5%. And so, we looked at, what's our exposure? If every dollar left that was over the $250 limit, how much money would that be, and would we be fine? And the answer is yes. So we've got $300 million of liquidity, and so what that basically means is that our customers could withdraw, up to $300 million before we'd have to start selling bonds or doing other stuff, So.
Now, Kreighton, as you're talking about this, I'm sure you've been asked those questions. I've been asked those questions, even though I'm not a banker, but I've been asked those questions, and I have some level of understanding of this, but people asking me, well, I have $100,000 cash in at the bank. Should I take that cash out, or and basically my answer to them was, as long as you have under $250,000, you've got absolutely nothing to be worried about, because you got that $250,000 level of the FDIC insurance. And if you're under that threshold, your money is insured by federal government. You've got nothing to worry about that. There's no need to panic at all. So am I correct in that? Is that accurate answer?
Yeah, that's very accurate. And although the SVB failure was a huge shock to us, it was not as big of a shock to the regulators. And let me just kind of describe how it works when a bank goes down and under. So the bank regulators are kind of like the referee in a boxing match. I mean, they are right there, right next to the action, watching exactly what's going on. And, in a boxing match, as soon as someone, they don't have to get knocked out for the referee to jump in and say, okay, this fight's over. They can get kind of a little bit unconscious or just, not be, cognizant, and the referee will jump in and say, it's done. The regulators are the same way. They are, there's a couple of metrics that are called the canary metrics, and it's basically based on the canary in the coal mine, and so if a bank hits, these metrics, then the regulators are right there, and they are watching the liquidity, they're watching everything. And so when it gets, when the bank gets close to failing, and I'm not saying like a hair's breadth away, I'm saying like, months away, they will start to look for another bank to actually buy them out. And most banks in America actually don't fail. They, the FDIC will step in and sell them basically to another bank overnight. So if you go to the FDIC website and you look at all the banks that have failed, in the last 15 years, next to almost every single one of them is failed and then taken over by Bank A or Bank B or Bank C. And so, I think it's like 95% of the time, the FDIC comes in on a Friday. So if they're going to shut a bank down, they come in on a Friday, and typically they do it after 5 p.m. And so they'll come in, they'll shut the bank down, and then on Monday the bank will open up, under a new name of whoever the FDIC sold them to. If you look back at the 2008 banking crisis, that happened with most banks. I was part of when when Wells Fargo bought Wachovia. That's what happened. They came in, they shut them down on a Friday, and then the next, on Monday they were owned by Wells Fargo. And so typically, if you have money in your account and your bank, and it's under $250,000, and the bank gets closed on that Friday afternoon, on Monday, like you relatively have no disruption. On Monday, you'll be able to log into your account and do all the banking that you need to do.
Okay. So thanks for that. Now, how our clients can know if their bank is safe, and what should they be looking at specifically, and what should be they're asking their bank? What kind of questions they should be asking?
So there's a couple different indicators, and then also remember, when you're asking a bank, if they're safe or not, what are they going to tell you? They're going to tell you that they're safe, right? And so I would say a couple things to look at. One is, if they're a publicly traded bank, look at their stock price, which can be misleading because, during this banking crisis, a bunch of bank stocks have been hammered. But it does point a little bit to which banks are investors worried about, and now sometimes that's not totally accurate, because if you look at like Zions Bank, for example, they're a giant regional bank. They're 100 and something billion, in assets. Their stock went down by 40%, but they're totally fine. And so why did their stock go down? Really, in America, I'm going to condense it. There's really kind of three different sizes or types of banks. There's small community banks, and then there's these larger regional banks, and then there's the top 5 or 6 large banks. And so, in this banking crisis, who right now is the most vulnerable? It's that middle sector. It's the large regional banks, and the only reason why they are getting hammered in their stock is just perception. That the smaller community banks, and by smaller community bank I mean a bank under 20 billion, which is there's a lot of banks under 20 billion, and most of their customers, like our customers, are under that $250,000 limit. They're very stable. They're very safe. The medium, size of bank is getting hammered because they've got large depositors that got spooked, and they are going to other banks. So the other thing to ask your bank specifically is, what is your capital ratio? And at a bank, the capital is basically the slush fund or savings account fund or emergency fund of the bank. And so, at Solera, our capital is $80 million. And so we could take $80 million, of losses basically, before we are in trouble. And so asking them what is the capital ratio, I think anything above 6% of a capital ratio is considered well capitalized, and so you want to make sure that your bank is above 6% in its capital ratio. So yeah, and then if they will give it to you, I would ask about their liquidity. How much liquidity do you have? We're pretty open with ours. It's $300 million. So yeah, liquidity and capital ratio, and then the stock price a little bit, but again, that's not a total indication of it's healthy or not.
Okay, thank you. So let's talk about the FDIC insurance. So can you give us a rundown on that, and let me know if you'd like that slide to be shared.
Yeah, and if you can do that slide really quick. So, there's lots of little nuances in this, but I just want to boil this down in like 2 minutes for everyone, just so it's very clear and very easy to understand. And so, Dmitriy, yeah. And so, bottom line is everyone, thinks that per signer there's $250,000 or whatever, but the truth is that the FDIC has different categories. So if you look at the screen in front of you, these are the different categories that the FDIC has. Each one of those categories has different rules as to what is going to be insured in those categories. And so I would say that the three main accounts that most of our customers would have, on the screen, or the three types of accounts, is single accounts, joint accounts, or business accounts, which is this corporation, partnership, or unincorporated association account. Okay, and so I'll give you just a rundown on those three really quick. Let's start with the easiest, which is actually the bottom one. Any business account. Any business account, they're going to give you $250,000 of insurance for the business EIN number, or for the business. They're not going to give you any additional insurance on any of the signers on the business account. It's only $250,000 per business or business entity. Okay. On joint accounts, they're going to give you $250,000 coverage for each signer on the joint account, and so you can have 3 signers or 4 signers, and you can get the $250 on each signer. On single accounts, you get $250 for yourself, and you get $250,000 for each POD or beneficiary. And what a lot of people don't know is that each of these groups are independent of each other. So you can get $250,000 by having a single account, and then if you're on a joint account in the same bank, you also get $250,000 on that. And then if you have a business account, you also get $250,000 on that. So that's one way to, spread out that FDIC insurance. And can we go to the next slide really quick, Dmitry? If you're wondering in your own situation, hey, am I FDIC insured? On the FDIC website, this is a snapshot of it. They've got this tool called EDIE, E-D-I-E, and basically you can type in the name of your bank and all of your different accounts and how much money you have in there, and if it's a joint signer or single signer, and it'll spit out a report for you saying if you're covered or not covered. Again, there's a bunch of little nuances there. And we could spend this whole webinar just talking about the little nuances. But I'd say if you've got some very nuanced questions, I would just go to this tool that's on the FDIC website, type in your information, and boom, in 2 seconds it'll spit it out and tell you if you're fully covered. And then the last slide. So most of you on here, if not all of you, are self-directed customers, and you're wondering, okay, you just talked about a business account, you just talked about a personal account and a joint account, but what about my self-directed checking account? And so right here, it's considered its own group. And so the self-directed, like if you look at the second one down, self-directed, plans and 401ks and IRAs are included in FDIC. And so your, those accounts are covered up to $250,000. Another note about FDIC insurance. There's 3 different deposit insurances in America. At banks there's the FDIC. At credit unions there's the NCUA, and then at brokerage houses there's the SPIC. But they basically all function the same, and they're all going to give you the $250,000, in coverage. Another thing that I think is interesting about the FDIC that no one knows or few people know is it does cost. I mean, it's insurance. So just like the insurance on your car, there's a premium and there's a cost to it, and who pays that premium is the bank. And so, the cost to us is about 10 to 15 basis points. And so that's 0.1 to 0.15, percent. And so we just have to pay that as a cost of doing business. The more risky or the more, if our capital ratio goes down, then the premium on our insurance goes up. So the safer we are, the less we pay in insurance, and the riskier we are, the more we pay in insurance, which makes sense. And most people don't know that, or most people think that the FDIC insurance is just something that the government just gives banks to help them out, but it's actually paid for.
Okay. So Kreighton, if someone has more than $250,000 cash in one account, what specifically can they do to get more FDIC coverage?
I'm going to answer that by saying most people don't care about FDIC insurance, unless something like this happens recently, And so, the first question you should ask yourself is, do I just feel comfortable with the bank that I'm in, And if you feel comfortable, then, because, going and getting all of your funds insured by the FDIC insurance is work, so if you're at a safe bank, it's up to you if you want to juggle, to go and do that. But there are ways to get over the $250,000. One is by spreading the money around, like I said, in the in those different accounts. But the main other way, rather than going to like 6 different banks and opening up an account at 6 different banks, there's a product out there that's called ICF, and it's put up by a company that's called IntraFi, and basically it allows you to keep all of your money at one bank, but on paper it farms out that money to a bunch of different banks, and so all of your money is insured, but you don't have to open accounts at 17 different banks. It just stays at one. So we are a part. Most banks are partners with with IntraFi, and so if that's something that you're interested in, you can talk to us if you're friends with us or your local bank. I'm sure that they've got that partnership. There is a cost to it, to put your money, out into that network or for it to get, insured. The cost is probably 10 basis points up to 25 basis points. So 0.10% up to 0.25%. With rates where they're at, though, I mean, that's not, or it didn't make a lot of sense to be in that network back when rates were low, because then you might actually be taking a loss on your, on your funds. But now with rates being high, if you're getting paid 2, 3, or 4%, then what's 0.25%, so that it's fully insured. So.
Gotcha. Well, I think it's not, it doesn't apply to probably most people on the call. That issue is for, for businesses. Maybe it applies to them on the other end, on their business side, where, if you, and it's probably to larger businesses that have to run the payroll, because most of our clients, they're solopreneurs. But if you're talking about your IRA and 401k money and checking accounts for your solo 401k or for your checkbook IRA, you shouldn't be sitting on that much cash anyways. That's just not a good practice. Your money is losing its purchasing power, and it's probably a different webinar topic that maybe we can talk at another time. But you want to have your money be working for you. Yes, there might be a period of time, myself including, I'm practicing what I'm preaching. I'm investing my self-directed retirement accounts, and sometimes I'm sitting on some cash, but it's never over 250. It might be $20,000-$30,000 until I find the investment opportunity to deploy that capital. And that's my advice to you. You shouldn't be sitting on that much cash. There's ways to put your money to work one way or another. But let's talk about some opportunities, because every time there is a crisis, there are also opportunities. What investment opportunities do you see when with rising interest rates? What can you talk about that?
Yeah. This is something that is actually pretty interesting that I think is not being talked a lot about in the mainstream media, right? And it's, they've talked about, okay, interest rates have gone up. How is that affecting housing? But they haven't talked about the other industries that rising interest rates disrupt, and where I think that there's going to be some opportunities. So let me speak on a couple of those, and then I'm going to let the viewers just take what you will from this this information, and in finding. I mean, I can't point specifically where you can go to see this, but I'm going to talk about globally how this can create some opportunities. One is on the commercial real estate side. As you drive around where you live and you look at all of the thousands and thousands of buildings that are around your home and your place of work, pretty much every one of those buildings has a loan on it. Very few people have have those buildings paid off. And unlike a mortgage, the rate doesn't change and nothing changes for 30 years. With most of those commercial buildings, they have to get fully re-underwritten every 5 years. Okay, and so let's think about that for a second. What if you bought your home and you've got your nice 2.8% interest rate, and right now you had to requalify for your home with the appreciation of the home that's gone on? Maybe your income has changed. If you had to requalify for your home, your payment would go up because the interest rates now are 6%. And so, you could be paying, $2,000 in a mortgage payment, but now it's going to be $4,000 or $5,000. And so then when you push that over onto the commercial real estate side, every commercial real estate loan that is coming due this year, their payment is about to skyrocket. And what does that mean? A bunch of them, the payment or the new payment might be more than, they might not qualify basically for the property. So, I mean, I think that there is going to be an opportunity on the commercial real estate side. I think that, there's going to be some, maybe some foreclosures on that side, or, maybe, they're going to have to raise rents on the, the occupants of the, if you own a strip mall, you might have to raise rents on everyone. And so just think about the repercussions of that. And, maybe there's going to be opportunities to invest your self-directed account in some commercial real estate. Aside from that, look at the auto industry right now. The average auto loan rate is 14%, which is ridiculously, sky high. 20% of all new auto loans have a payment of $1,000 or more, And so basically what I'm saying here is that's unsustainable. And I think that we're going to see a crash in the auto loan, or in the auto sector. And so how do you capitalize on that opportunity? I don't know, but I think that there is going to be, any time that there's a crash, I think that there's going to be opportunities there. I remember back when oil prices, in what was it, 2008 or 10, skyrocketed, and everyone was just offloading their SUVs. They were just trying to get out of their SUVs because the gas mileage and stuff. And so those are two areas where I think that there's going to be some opportunity for self-directed investing, in the coming months because of the interest rates.
Okay.
The last thing is just in personal lending right now. I mean, everyone's talking about this impending recession. As soon as the recession hits, then rates are going to go down. And so if you can lock in, if you're lending right now inside of your solo 401k, if you can lock in some higher rates, I would say do that now, because in 6 months and a year, rates could be back down, and then your return is going to be lower.
Yeah, I agree. So a question. Let's get to some questions from our participants. I have two accounts at the bank, and individually they are both under 250, but together they're over. Am I protected?
So, if they're in the different categories, like I mentioned, then you are. If they're in the same category, so I mean, if you've got two sole owner accounts, then then it's just it doesn't matter how many different accounts you have. It's 250 for that category. And I would recommend anyone with these kind of very specific questions, go to that just go to the FDIC website, type in exactly what you have at the different banks, and it'll spit out to you if it's FDIC insured or not.
Okay, yeah. So it's per social security number, not per. So it's two individual accounts, and they're combined over 250. Then 250 is your limit. But if you have something that I learned from you earlier, and I want to make sure I understood it correctly, that if I have an individual account, I get 250 protection there. And then if I have another joint account with my wife, two of us, then there is $500,000 protection there on that account. Is that correct?
Yes.
Okay.
Yes. So the different categories, and that's where, I mean, most, or, you know, there's a mistake that's set out there that is that the FDIC insurance is per social security number or per tax ID number, and that is not necessarily true, because if you have different categories like the single account, the joint account, or the business account, then you get additional insurance there.
Gotcha. Question. I don't know if you can answer this, but let's try. Is Schwab safer than Chase?
I would say no. And I mean, I think Schwab is very safe. I think, but I mean, Chase is the largest bank in America. I think their asset size is $3 trillion. They're too big to fail. You know, that doesn't mean that I think that Schwab is unsafe. I think Schwab is safe, but Chase is safer. You know, this whole crisis is causing a bunch of people to transfer their money to the big four: Bank of America, Chase, Citibank, you know, and Wells Fargo. But there's a reason why a lot of Americans don't bank at those big four, and that's because they're giant and their service is not great, and they don't provide all of the different niche services that, you know, that you need. So I mean, there's each bank has its own clientele that it can serve better than, you know, than other banks. You know, in this self-directed, you know, space, most of the big banks, I mean, I know especially Chase, if they see one of these 401k accounts, then they, you know, they don't really understand them well. They don't want to deal with them. Sometimes they close them down. And so yeah, sorry, I'm going off on a tangent now. So anyways, yes, I think that Chase is safer, but I don't think that Schwab is unsafe.
Okay. Thank you for that. Kreighton, there is a question came in, and you can see it in the Q&A. I assigned it to you. Can you read that? From
the value of the bonds they sold are now worth less than what they paid. The government has offered to allow them to value the bonds at what they sold it at, not what the bonds are really worth. This is a bailout, and yes, it is the regional banks in jeopardy, also mismanagement. The banks that failed did not have a risk officer for the previous 6 months. Please address these thoughts. So, you know, everyone is blaming SVB on their bond portfolio, and you know, that their mark to market, you know, basically that they were negative on their bond. Let me just say this about bonds and banks. Almost every bank in America has bonds in their portfolio, and most banks it's like 10 to 30% of their portfolio. And most of those bonds were bought pre-April of last year. And so every single bond, or almost every bond, that every bank has that was bought before April of last year when the rates started going up is underwater. Those bonds are underwater. And I mean, those bonds are fine. It's just if you tried to sell them today, you just couldn't sell them for what you bought it for. I don't think that is what caused SVB to go under. What caused SVB to go under was that they had their depositors pull all their money out, and they were forced to sell those bonds. The thing that doesn't make sense, though, is that if you look at all these government programs that banks have for liquidity, one of the main ones is pledging your bonds to the Family Home Loan Bank or to the Fed, and they will give you a line of credit for whatever the value of your bonds is. And so, we've got a couple $100 million in bonds, and we've pledged all those bonds, and so basically those bonds for us are like cash. because we can pull basically the money from those bonds if we ever needed liquidity, and not have to sell them and take the loss. One thing that the government just did to try and stabilize the banking industry is, in the past, as you mentioned in your comment, they would only give us credit for the market value of the bond, but now they're giving us, when we're pledging them, the purchase price that we purchased the bonds, or the market rate. So I mean that just gives us, I guess, a little bit more of a line of credit, for those bonds. Is this a bailout? This is a bailout. Yes, it is, by the FDIC fund. And so, these banks, SVB and Signature, and by bailout, who's getting bailed out here is not the owners of SVB, but it's the depositors are getting bailed out that were over the $250,000, and they're getting bailed out by the slush fund that is all those premiums that we're paying. So we're paying 10 basis points on $1 billion, right? So we pay that every month, and so that all goes in this big FDIC fund, and it's just there for when banks fail. And so they've got a ton of money that's in there, and that's what's going to bail out the depositors at SVB and Signature Bank.
Another good question we have is, what has Solera National Bank done differently compared to other banks to overcome this crisis? I think you touched on this, but
yeah. I think transparency is the key to everything, and I feel like what we've done, and I don't know if it's different, but we've been very transparent with our liquidity and and how much risk do we really have. As I mentioned before, only 5% of our accounts are over the $250,000 limit. And we've got $300 million in liquidity. But when I tell people that, it just sounds like this big number. Okay, so $300 million, like what does that mean? Put that into perspective for me. So to put it into perspective, our average daily churn of deposits, one way or another, of money coming in or money going out, is 2 to 5 million. Okay, and so so we've got 300 million of liquidity, right? And so I hope that gives some perspective. If our churn was 50 million a day and we only had 300 million of liquidity, then you go a couple times above our baseline, and that like it's scary. But because our churn is only a couple million a day, the 300 million in liquidity is a ton. So
yeah, I think one comment that I want to make is that you don't want to become a crowd. You don't want to, because I think part of the problem what happened is that's not a major a reason, but I think part of that is when you're part of the crowd, you become, and there's been a study on that. I actually listened to some analysis on this. The crowd takes a mind of its own. You're no longer thinking as an individual. So again, I think the summary is that you got to think for yourself. Do you have more than $250,000? If you don't, then you've got nothing to worry about that. Leave your money there. It's safe. You don't need to panic, because if we have 100 plus people on the call today, if everyone had 250 and everyone will start panicking, that's $25 million. And you said in your case it's $2 to $5 million daily. So that will create a problem. But there is really no risk for those individuals there. So you don't want to be or go with the crowd. You want to think for yourself.
Yeah.
But great discussion. I think our time is up. We're going to wrap this up. Thank you, Kreighton, again for giving us your time. Great discussion. I just want to mention that there's been some questions on the solo 401k, which today is not the time for those questions. So I'm going to defer them actually on Monday. On Monday at 11 a.m., we do have a Q&A live webinar where you can ask your questions. So I'm actually going to be answering those questions there on Monday. And then on Wednesday, the 29th at 12:30 p.m., we do have a tax presentation with the topic real estate tax strategies to supercharge your wealth building. A great presentation. Amanda Han will be presenting. So go ahead.
So there's a bunch of questions here, Dmitry. Am I able to write answers to these after the webinar, or how does? I mean, I want to make sure that everyone's questions get answered.
Yeah, well, if you're okay on time, let's maybe we can give it another 5 minutes or so. See if you can get some of those.
Sure. So I'm just going to start from the bottom up. There's a comment here saying that we're $1 billion in assets, and so if we have $300 million in liquidity, that's only at 30% liquidity. Again, this comes back to perspective. What do most banks have in liquidity? It's like 10 to 20%. Most banks in America, their liquidity is 10 to 20%. So 30% is actually high. I know that doesn't sound high, but in banking, most customers are leaving their money in the bank, and that churn of money that's coming out and coming in is a very small percentage of the bank. It's only 1 to 5% of the bank is churning. Now, with SVB, they had a run on the bank, and so when you've got 20 or 30% of your deposits going out, there's pretty much no bank that if you have a run on the bank, you can stop it, or not stop it, that you won't go under. If there's a true run where everyone is pulling their money out, then because the majority of those deposits are invested in loans or in bonds, so hopefully that gives some perspective on that.
Okay, let's do one more. My understanding is
Sure.
that the banks failed because of the interest rate went up the value. So is that accurate assessment?
The interest rate going up made the bonds have less value to them. But what made the banks fail was customers pulling their money out. That's what made it fail. And then the bank had to, and the other thing is, if you look at SVB, they were a tech bank. And not only were there, so before the run on the bank, what was going on and why was it declining? It was declining because all these tech companies that used to have millions and millions of dollars in their account stopped receiving funding from investors. Okay, so their bank accounts started to just crater downwards. So let's say they had 10 million, and then it was going to 9 to 8, and so just the deposit levels in general were going down at SVB. If you look at Signature Bank, the same thing happened, but it wasn't the tech sector; it was the crypto sector. So crypto, crashed earlier this year. Signature Bank was one of the big banks that banked, crypto, and they had a ton of deposits that were from crypto. Well, when it crashed, those deposits went away, and then their liquidity was under pressure, and so that's really the precursor to both of those banks was that they were too concentrated in their customer base, and the industries that their customers had were struggling. I mean, if you look back at 2020, you'll see that most of the deaths in America were COVID, and magically, the cancer deaths went down, but did the person really die of COVID, or did they die of cancer and they just had COVID at the very end? And so, did these banks go down because of bonds, or did they go down because of something else? But then just the final straw was the bond. That's my personal opinion, that it wasn't the bonds. It doesn't matter what their bond portfolio would have been. Because even if they would have had to liquidate all those bonds, their capital would have been going down, and there was a run on the bank, and whether the bonds were underwater or not, I think that they would have gone under.
Okay. Well, we got a few investment-related questions, and we're not going to be talking about them here. We neither Kreighton nor myself, we do not offer investment advice, and so we are out of time. But again, thank you for joining us. Thank you, Kreighton, and I look forward to seeing you on Monday at our Q&A, and then on Wednesday on our tax seminar. Thank you so much, and you guys all have a great rest of the day and the weekend.
All right. We'll see everyone.